Welcome back to the Pro Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines, everyone.
It's a really dense set of sources we're diving into today. The
Mhm.
reports reflect a market that seems, deeply unsettled by politics, both here and abroad,
hmm
even as we see some incredible corporate innovation happening.
Absolutely. And that's our mission today, really, to cut through all that noise. The financial reports from yesterday and today show this striking convergence of political volatility and groundbreaking corporate strategy.
hmm
We've boiled it all down into three main threads for you. First, the immediate market shock we're seeing from geopolitical flashpoints.
Mm.
We're talking Iran and, believe it or not, Greenland.
Right.
Second, we'll look at the tremors here at home, the political attacks on the Federal Reserve, and these new proposals targeting credit card rates.
A huge deal for the markets.
And finally, a really fascinating contrast, a look at a potentially revolutionary new drug versus a very contentious activist battle in the world of niche finance. So, okay, let's unpack all this volatility.
We have to start with the oil market. It just reacted instantly to the news coming out of Washington and the Middle East.
That's right. The CNBC Daily Open had the details. President Trump tweeted he'd canceled all meetings with Iranian officials. And then he very publicly backed protesters in, one of the biggest anti-government demonstrations that region has seen in a while.
And the market's reaction, it wasn't just big, it was immediate. WTI crude and Brent, the global benchmark, they both jumped more than 2.5%. Just like that.
And the reason for that is key, right? It's not just about Iranian oil production itself.
No, not at all. It's the fear. The fear that Washington getting more involved could disrupt the flow of oil through the Strait of Hormuz.
The choke point, the single most vital choke point for global oil.
Exactly. Something like a fifth of the entire world oil supply passes through that tiny little waterway. So any political move that even hints at threatening that flow, it gets priced in globally right away.
And when that happens, money runs for cover.
We're seeing that pattern play out perfectly in the sources. All this global insecurity is pushing gold and silver prices higher. Silver is actually at a record high. Gold is right near its all-time peak. It's a tangible barometer of investor nervousness.
So if the global risk is these flashpoints overseas, the risk here at home seems to be aimed right at the heart of our financial system, the Federal Reserve.
Yeah, the independence of the Fed is under what you could only call a sustained, aggressive political attack.
And it's gone way beyond just insults, though we're still seeing plenty of those.
Oh, absolutely. The president has kept up the public criticism of Chair Jerome Powell, calling him a jerk, crooked, a bad Fed person. But the real friction point, the escalation, is the Justice Department launching a criminal investigation into him.
And the reason for that investigation, cost overruns on the renovation of the Fed's headquarters. A massive number, $2.5 billion. It's an easy headline.
It is. But what's so fascinating is how that's being used. Powell himself isn't even pretending this is about cost control. He came out and called the whole probe a pretext.
A pretext for what, exactly?
For a broader pressure campaign, all about setting interest rates. He's basically saying this isn't about renovation costs. This is a fundamental attack on whether monetary policy is guided by economics or by politics.
That completely reframes the entire narrative, doesn't it? It's not about the money. It's about delegitimizing the institution itself.
And that threat, that has triggered an international response. The heads of the ECB, the Bank of England, they issued this joint statement affirming full solidarity with Powell.
Wow.
Yeah, that tells you just how worried the rest of the world is.
Yeah.
If the Fed's independence is compromised, the confidence that underpins the entire global dollar system starts to crack.
Okay, so from institutional stability, let's pivot to macro policy risks. Because the tariff situation is still reshaping U.S. trade, and often in some really counterintuitive ways.
The latest revenue data from the Treasury really paints a clear picture. U.S. tariff revenue actually dropped by almost $3 billion from November to December of last year.
Which is the second straight monthly decline.
Right. Down from a peak of over $31 billion to under $28 billion. And that drop, it's not really a sign the policy is working as intended. It's a reflection of global trade contracting.
The shipping data in one of the reports was stark. U.S. imports from China fell 28% last year. Exports to China fell even more, 38%.
That's a huge contraction.
Yeah.
And the uncertainty is just getting worse because everyone is holding their breath for the Supreme Court's ruling in Learning Resources, Inky v. Trump.
And that case will decide just how broad the president's tariff authority really is.
Exactly. And alongside tariffs, there's this other domestic policy fight heating up over consumer finance. The president's renewing his push for a one-year cap on credit card interest rates, a 10% cap.
10%. I mean, that would have a massive impact on the asset-backed securities market, the ABS market.
A huge one. This is how all that credit card debt gets packaged up and sold to investors. And JP Morgan strategists are estimating that a 10% cap would cause something they call excess spread to just plummet.
Okay, let's pause there. For anyone listening, what is excess spread and why is it so important for these bonds?
Think of it like a safety cushion or an insurance fund. It's the difference between the high interest rate a bank charges you on your credit card, say 25%, and all of their lower costs, their funding, admin, and the payout to the bondholder. That extra bit, that spread, is what absorbs the losses when people default.
So if you cap the interest rate at 10%, that cushion basically disappears.
It's gone. JP Morgan says it would drop the spread to levels we haven't seen since the 2008 financial crisis. And the bonds that get hit the hardest are the ones backed by non-prime borrowers.
Higher risk borrowers.
Right. And if you force the rate down to 10% for that group, there's just not enough money coming in to cover potential losses. It makes it economically impossible to lend to them at all.
Which is the exact opposite of the policy's stated goal.
Wow. Okay, let's connect these fights, tariffs, interest rates to the bigger picture. The World Economic Forum's new Global Risks Report for 2026, it offers some alarming clarity here.
It really does. The WEF survey confirmed that this environment we're describing is now the #1 short-term threat globally. They call it geoeconomic confrontation.
Which is just a fancy term for weaponizing things like tariffs and supply chains.
Precisely. But the report also highlights a danger that has, and I'm quoting, soared higher and faster than any other in their long-term risk survey.
Artificial intelligence.
Yep, AI. It jumped from 30th place last year all the way up to the 5th biggest long-term risk. That's a staggering move.
It signals a really deep structural fear, doesn't it?
It does. The report warns that AI-driven labor displacement could cause these massive spikes in income inequality, leading to, vicious cycles of economic contraction. There are real fears about humans losing control or facing mass unemployment. Okay, that is a huge systemic risk hanging over everything. Let's shift gears completely for a minute. Let's look at a sector that is still delivering incredible innovation. I'm talking about pharmaceuticals.
Right. There were some fascinating comments from Amgen CEO Bob Bradway talking to Jim Cramer. He was discussing their experimental weight loss drug, MariTide.
And he highlighted something he called the patient persistence issue.
The persistence issue, yeah. Which is basically the biggest problem in this booming weight loss market. People take a drug, they lose weight, but then they stop taking it and the weight comes right back. It's a huge challenge. And he thinks MariTide can solve it.
And the key is the dosage frequency, right? Because most of these injections are weekly.
That's the massive differentiator. Their trial data showed patients kept their weight off for 2 years on a monthly injection.
A monthly shot. That's a huge deal for compliance.
A monumental deal. And it gets better. He said they're encouraged by data that suggests it might even be taken just quarterly.
Quarterly. Okay. That would be completely revolutionary. It basically solves the biggest hurdle for patients.
And this focus on long-term management, it just underscores Amgen's whole strategy. They're experts in biologics. It's why they bought Horizon Therapeutics. This is a deep, multi-year investment in solving the hardest part of the problem.
So while Amgen is innovating, we have this other high-stakes battle playing out in a very different corner of finance, a place where value is extracted through confrontation, the UK investment trust sector.
Yeah, a market worth about £265 billion, $357 billion US dollars.
And this sort of quiet, sleepy sector has been, as one source put it, electrified by an activist investor from Wall Street, Boaz Weinstein.
Right, founder of Saba Capital. He's famous for some big wins, like betting against the London Whale years ago. Now he's launched these aggressive campaigns to oust the boards of several UK trusts.
And his goal is basically to close the gap between the stock price and the actual value of the assets, right, the NAV.
That's the whole play. These trusts, they have a fixed number of shares, and their stock price often trades at a big discount to the value of what they own, the net asset value. That discount is averaging 15% right now.
15%.
Yeah. So Weinstein's goal is to force them to liquidate, to sell the assets, so shareholders get cash that's closer to that higher NAV, not the lower stock price. He's trying to unlock that trapped value.
And the main case study here is the Edinburgh Worldwide Investment Trust, E1PT.
A huge fight. Saba has built its stake up to over 30%. And the controversy is all around EWOD selling part of its stake in SpaceX. a stake that had returned, get this, 950%.
Wow. But Sava's argument was that they sold it at the wrong time.
Exactly. They sold it right before a secondary share sale. Sava said it defies commercial logic and left millions on the table. The board had to defend it, saying they had a rule to follow, but even their own chairman admitted the optics don't look good.
So now let's circle all the way back. Let's tie that initial oil market jump to the broader geopolitical game we mentioned at the start. Because these U.S. actions, Venezuela, Iran, now Greenland, they're not random.
No, analysts are pretty much in agreement on this. They see it as a coordinated U.S. strategy to directly challenge China's dominance in critical minerals.
The stuff you need for EVs, for AI, for defense.
Everything. And the stakes are just enormous. China controls something like 90% of the entire global processing capacity for rare earths. This is why a place like Greenland becomes such a critical strategic prize.
For its potential mines and the new sea routes opening up in the Arctic, the Polar Silk Road.
Right. But the local politics are complicated. Greenland's Prime Minister, Jens Frederik Nielsen, stated flat out, if we have to choose between the USA and Denmark here and now, we choose Denmark.
And the president's response was just to dismiss him.
Yeah, saying, that's their problem, I don't know who he is. So now, ahead of this big White House meeting, the U.S. is looking for leverage. Analysts are suggesting an off-ramp option.
What's that?
A Ukraine-style minerals deal. The U.S. would get access to Greenland's rare earths in exchange for security guarantees. It lets Washington claim a win without having to deal with the whole sovereignty question.
It's a classic security for resources play, but the sources also mention the absolute worst-case scenario, the ultimate threat.
Military intervention. It's incredibly unlikely. But the fact that it's even part of the discussion is staggering. The geopolitical cost would be catastrophic. Danish forces and NATO ally would legally have to resist. It would shatter U.S. alliances.
So as we wrap up this deep dive, the real insight is just how much market movement is now being dictated by political risk, from the Fed and Iran to tariffs and AI. But, underneath all of that, you still have this incredible corporate innovation like Amgen and these gritty financial battles like the UK trusts.
And that leaves a final thought for you to consider. The U.S. actions targeting China are all about energy and resource security, from oil in Venezuela to minerals in Greenland. So if the ultimate goal is cheap power and resource independence, how long does it take for corporate strategies to fully realign with this new bipolar world? You see Amgen investing for years in a quarterly drug, but at the same time, BP just announced it's writing down $5 billion on its green energy businesses. The time horizons of politics, finance, and science are just completely out of sync right now.
We'll see you all tomorrow morning with new headlines from major financial magazines.